All right, how does this all filter into our investment outlook? And the reason why I stress this so much is that's what's really driving the dynamics in the global marketplace. Remember, we were on the gold standard up until Nixon closing the gold window in like 1971. And since then, we've had a couple of major moves in the US dollar. One in the mid 80s, one in the mid 90s, up 60% the first time, 43% the second time. And here we are finding ourselves in the midst of another move, so far up 25%, now I think more like 29. And there are some reasons to expect that the strength of the US dollar can continue. For instance, as I've shown you, the Fed is tightening policy while the Bank of Japan and the European Central Bank are loosening policy. Economic growth in the US has been stronger, relatively, than it's been in specifically Europe and Japan. The reason I'm singling out Europe and Japan, by the way, is if you look at the US dollar index, Europe and Japan make up like 60% of the US dollar index. The rest of the countries matter, but it's really Europe and Japan that determine our currency value. U.S. interest rates are relatively high. Believe it or not, you pay 1.7 for a 10-year in the U.S., or you get paid. In Germany, you'll get 40 basis points. So the spread in the U.S. relative to foreign interest rates is actually pretty high. Some places in Europe, you have to pay the government to take your money. Really odd. U.S. domestic energy production has been good. It's improved our trade balance. Now, obviously, oil prices bounce around. But on net, that's a positive for the currency. And the fact that Washington can absolutely get nothing done is actually very positive for the currency. So, yes, if we want to all clap for that, we can. We'll clap for me, the staff, and then the fact that the government can't get anything done. All right, so this could be good for U.S. stocks. If you go back and you isolate years when the dollar's risen 10% or more and said, what did U.S. stocks do the following year? It actually ended up being pretty good for U.S. stocks, as you can see. I think I've lost my pointer. But on the left side, we've got U.S. stock returns and then U.S. dollar prior year. And so you can see, again, the years correlate with the 80s and the 90s where we went through a big surge. But overall, it ended up being pretty good for the market. But there is a consequence to a strong dollar, right? It's a zero-sum game, right? So if one country's currency goes up and the other goes down, you're transferring a little growth. Well, U.S. corporations, in terms of analysts' expectations for 2015 earnings, have seen a great decline in the expectation of earnings power over the coming year. So 6 months ago, before this currency move, analysts expected a 15% basic growth rate in earnings in 2015. That's now down to 4.7. So the headwind of the stronger dollar has crimped a lot from U.S. corporate earnings. And that's not necessarily good news, since where we are from a valuation perspective is actually well above fair value. So if you look at this chart, there's a little pointer. This shows you fair value and then one standard deviation above, one standard deviation below, and we're actually in zone 3 right now. And what zone 3 tells you is that once you're in zone 3, the following years end up being positive maybe 62% of the time. Your average return would be about 2.6%. To make the numbers a little nicer, your average up return is actually 13%. But as we know, the law of mathematics applies to the markets, and as the market gets more highly priced, the forward return expectations must fall, and so they have. Small cap stocks in the U.S. are actually more expensive than mid caps still. They've come in a little over the past year, as I showed you the disparity in returns, but they're still 25% more expensive than large caps relative to an 8% long-term average. And the U.S. economic recovery is graying a little bit. We've actually been at this for quite a while. So we're 60 plus months in. The average advance going back to 1900 in the economy lasts about 45 months. So this is actually the 6th longest economic expansion we have on history. And the stock market is graying a little bit as well. So this is now the 4th longest bull market we've ever had. And in fact, if the market turns positive and ends the year, this calendar year positive, this will be the first time ever, going back to 1874, that we've had 7 consecutive calendar years of positive returns. All right, since those were depressing, here's some charts that make us smile. We are in the 3rd year of the presidential cycle. For whatever reason, that ends up being a powerful year for the markets, typically up about 13.5%. There's also an oddity out there called the rule of 5, which is years that end in 5 end up having pretty good returns. You can see average 25%. If you marry these two, it really gets fun. So there have only been 4 of those, and the average rate of return has been 45%. So we've got that going for us, which is nice. I will also tell you that it is the year of the sheep in China this year, so we have that going for us. The 2 lucky numbers are 7 and 2. I was born in 1972, so these are all very powerful reasons to get really long in the stock market.